Hello everyone, welcome to Akira's Academy of Accounting and Finance, and today we are going to start with our second chapter, the theory base of accounting. Apologies. Let's start with an example. Okay, so you all are in 11th standard, right? Your board is NCERT, that is being central board. Okay, now the central board is conducting exams, and that exams are at the same part level for everyone. The guidelines are same, everything is same, or else we can say we have certain other professional bodies conducting other exams, like there is CA exam, CS exam, JE, NET. For all of them, they have to follow a certain guideline. Okay, it's not like that somebody can give exams at some particular point of time, or somebody and some other point of time. Somebody can give exam for 3 hours, somebody can give for 4 hours, somebody can just finish the exam in half an hour. So everything is same. Okay, so that form a proper base of everything. If that base is not being formed, if it is not uniform, and if it is not consistent, can you rely on it? Obviously not. Okay, similarly, when we are preparing our books of accounts, okay, what we are doing, we are identifying the transaction, measuring, recording, classifying, summarizing, and communicating. To whom we are communicating? To the users. Now if we are like the users want to know how consistent it is, how uniform it is, whether it is going to show a true and fair view of it. So we need to have a proper base of accounting. We have to follow certain rules, we have to follow certain guidelines, which is being already decided by a certain professional body, Institute of Chartered Accountants of India. That is a professional body which has already decided what guidelines we have to follow while preparing our books of accounts, because that books of accounts are being interpreted and decoded by whom? By the users. The users don't know how the company is performing unless they see the books. Okay, and for those users we have to follow a certain guideline. If that guideline, if those principles are not being followed, if we don't have certain rules and regulations while preparing the books of account, then that books of account doesn't show a true and fair view. We have seen why they need it for comparison, to understand it, to compare it. The shareholders are investing money in the company. When the shareholders are investing money in the company, they need to see different companies, how different companies are performing. But if different companies are making their books of accounts in different ways, then there is no comparison. Okay, in a class of 30 students, if everybody is giving exam in a different way, how we can say that the 11th standard students are performing better? Like which student is performing better, which is not performing better? So they have a certain platform, they have a certain guidelines which they have to follow. And similarly, in this, when we are preparing the books of accounts for our users, the end is the users who are going to use it, who are going to take decision based on your books of accounts. So there is a body, ICAI. They have framed certain rules, certain guidelines, certain principles on the basis of which we are supposed to prepare our books of accounts, and that is known as generally accepted accounting principles. What is generally accepted accounting principles? Just see the term generally, it's generally being accepted. What? Accounting principles. So they are what? The rules or guidelines. They are the rules or guidelines. Why they are there? Adopted for recording and reporting of business transactions. Whenever we are recording any business transaction, the moment we start identifying the transaction, we record it, we measure it, we summarize it, we communicate it in the books. At every point of time, we have to take into account these accounting principles. Why? To bring in the uniformity, so that it is uniform. Even though if the manager wants to compare his books of accounts from the past year and with the current year, how he will get to know if his accounting policies are different? Last year he was performing certain accounting policies. This year he has changed. There is no comparison. So for inter-period comparisons and inter-period between two periods, accounting periods, and inter-firm between two firms comparison, we need certain form of uniformity and consistency. It has to be consistent. Okay. For what? For the preparation and presentation of financial statements, we need to have a proper base of accounting. That is what we are going to discuss in this second chapter. So these accounting principles, some call it principles, some call it postulates, some call it concepts, some call it conceptions. There are different terms for these accounting principles. They are based on certain assumptions. When we say concept, the accounting concept, it is based on certain assumptions and ideas. Okay, when a user is using the financial statement, when he is looking at the financial statement, he know that these assumptions are being followed. That is the idea behind making this certain thing, or we call it convention. Convention means a custom that is being it is customized in that way. It is a tradition that is like, there are certain traditions now. Like in a festival, or we follow certain tradition. Okay, this is being customized in that way. This is a tradition we follow. Similarly, in accounts, there are certain customs and traditions that we follow while preparing our books of accounts, and they have been summarized uh, in this basic accounting concepts, and we are going to discuss each and every accounting concept in the easiest way possible. Okay, so the first accounting concept is a business entity concept. Business entity concept, as I said to you when earlier also, when a business is being formed, entity is a separate legal entity. The owner is different, the entity is different. We cannot, like for example, the owner is buying a mobile phone. Okay, now he cannot charge for his personal use. Okay, not for the purpose of business. If he is buying a mobile phone for the business, it's okay. But if he is buying a mobile phone for his business, for his personal use, he cannot charge that mobile phone expense from the revenue of business. Okay, so that is why it is said, why we say the capital is a liability for the firm, for the entity, for the organization, because the owner is considered as a separate legal entity. In fact, when we say that he is withdrawing certain amount, that drawing is reduced from his capital, that drawing. But if he is taking certain amount, if he is taking certain things from the business, that is being reduced, so as the liability of the firm is reduced. That is why the business is considered as a separate legal entity and the owner is a separate person. We cannot merge the owner's expenses with the business expenses. We cannot charge the owner's expenses or income with the business. Okay, so the first concept is separate entity, business entity. Money measurement. Money measurement concept. Okay, now any transaction, any event, any transaction, whatever transaction is happening, if it can be measured in monetary terms, then only it is recorded. This is the basic accounting concept. When we did the definition also, at that time I also explained you, even if there is a person who is very hardworking, who is very efficient, uh, who is very, like, who brings in certain good things for the business, but it cannot be recorded if he has left the organization. So only those transactions which can be recorded in monetary terms. Now if I say I have 50 computers, I have 20 machineries, I have this furniture, that I can't write in my books that I have 50 computers. I cannot write I have 20 machineries. I can't write that I have this furniture, I have a good sofa, I have this, I have that. I can't write it. What we have to write, we have to calculate 50 computers. If I say it's of 1 lakh, then I have to write 50 lakhs in my books of accounts. If there are 20 machineries worth rupees 50,000, I can't write 20 machineries. I have to write 1 lakh amount. I have to show it in the monetary terms only in my books of accounts. Okay, so that is the money measurement concept. Anything which can be recorded in monetary terms is recorded in the books of accounts. Otherwise, it is not recorded in the books of accounts. Third is going concern concept. The going concern concept is like, if I have started a business, whenever I am showing my books of accounts, that books of accounts represent that my business is going to continue for a period of time. It does not mean it will stop like it for a year or for a 2 year. Going concern, it is going to continue for a period of time. Now, when I say like in the assets, we discuss like we charge depreciation, right? Depreciation like certain amount, a certain uh, asset I have used it, that asset I am going to uh, the part of which I have used it, only that much part I am going to charge it from my books, from the revenue of that year. Okay, so when I am buying a machinery worth rupees, anything worth rupees 1 lakh, I'm not going to charge 1 lakh entirely from the revenue of that particular year. My intention is, okay, this particular machinery will be used for a period of time. Okay, so I will charge only that much amount which I am going to uh, you know use it for that particular year. That is why there is, let's say, 10,000, I'm going to charge this much only, because my intention is I'm going to use it. And why this assumption, on what basis this assumption is based? On the basis of a going concern concept. Okay, the third is accounting period concept. Okay, now accounting period, like you are in 11th standard, your 11th standard will be there for 1 year. Okay, then 12th standard, like every year there is one particular year. Okay, similarly I can't say like on basis of that year your results is being formed. Similarly in accounts, when we are preparing the books of accounts, there is a particular year. That year we have to follow, which has been like income tax act also, the Companies Act also, they have also specified that we have to follow a particular year in which we are supposed to prepare our books of accounts. Usually it starts from 1st April and ends on 31st March. If this particular year, it becomes easy for the firm also for comparisons. It is like how am I performing from that 1 year. I'll get to know, okay, how my business is going on. I can't say, okay, let's do it for 2 years and then I will make the books of accounts. It's not like that. uh, at some firms, like if there are certain instances, there are certain exceptions to this, like when a partnership firm, a partner um, is there's a retirement of partner, then they have to prepare books of accounts. Or in case of companies, the shareholders are investing money, the Tatas, the Birlas, the Reliance, Hyundai, all these are big companies. They have to prepare quarterly, every 3 months they have to prepare books of accounts, because the shareholders wants to know how the business is running. They uh, on the basis of that they will invest amount in it. Okay, so there is an accounting period concept. We prepare books of accounts for a particular period. Then there is a cost concept. We can also say it as a historical cost. When I say historical cost, any transactions, like I am buying a building worth rupees 1 crore. Okay, now my cost the day I am buying is 1 crore. Okay, after few years, the value may appreciate, may depreciate. Okay, it may become 90 lakhs, it may become 1 crore 10 lakhs. Okay, that market value keeps on fluctuating. It does not remain same. What historical cost says, the price at which you are buying your building, that price you are supposed to record in your books. Okay, now if I am buying a building or if I am buying any plant and machinery, uh, I have to get that machinery to my premises. And if I'm paying certain transportation charges, certain loading charges, certain unloading charges, installation charges, all these charges are being machinery worth rupees 50 lakhs. If I'm incurring expenditure of transportation worth rupees 20,000, if I'm paying 10,000 for unloading and unloading charges, 20,000 more I'm paying for installation. So I will show my machinery in the books as 50 lakh 50,000. 20, 10, 20, okay. 50 lakh 50,000. This is the cost which I am going to show in my books. Now that machinery after 1 year may become 60 lakh. That machinery after 1 year may become 45 lakhs. The market value keeps on changing. We are not supposed to show the in our books the market value. We are supposed to show the cost at which we have purchased our machinery, at which we have dealt with our building, all these things. Okay, so the cost concept shows that in the books of accounts we are supposed to record all our assets, all our transaction on the basis of historical cost. Third is dual aspect. Mm, there is a thing called assets equals to capital plus liabilities. Okay, now dual aspect, every transaction has a dual effect. That is why our assets will always be equal to the capital plus liabilities. Let's say if I am buying a machinery, 50 lakh 50,000 worth of machinery. Now 50 lakh 50,000 worth of machinery, that assets come into my business. I'm buying that machinery on loan. Okay, so that increases my liability. Bank and financial institution, I took a loan from it. So 50 lakh 50,000 will always be equal to 50 lakh 50,000. That is, asset will always be equal to my capital plus liability. Why? Because there is every transaction has a dual effect, double effect. Let's say I am selling goods somebody on credit. Okay, if I am selling goods somebody, my goods, my stock inventories, okay, my stock is reducing. At the same time, if I'm selling it on credit, or I'm selling it on, let's say if I'm selling it on credit, my debtors will also increase by that amount. 10 lakh amount of goods I have sold to somebody, that somebody has not given me the money, so he becomes my debtor. So the same way, if the asset is being reduced by same amount, this another asset, debtors, will increase by the same amount, so it will always remain equal. Or else if I am purchasing something on cash, if I purchased, the goods came into my business. Similarly, if I purchased on cash, my cash reduces by the same amount. So every transaction has a dual effect. It's a double entry bookkeeping system of accountancy. Okay. Third is revenue recognition. Now, when to recognize that? What is revenue? What do you mean by revenue? Revenue means we have received an income, and that income majorly happens. What is the major source of income for the firm? The sale of what? Goods and services. Okay, the major source of income is sale of goods and services. Okay, and the secondary source of income may be somebody is using our resources. Like I said, there's a godown lying down. There's a certain godown which is there and I'm not using it. I have rented it to somebody, so that person is using. So these are the major two sources of income. Now when this income is recognized, the sales is recognized, or the revenue, when the revenue is realized, when the revenue is recognized, when in case of sale of goods and services, if I have sold the goods, the moment I sold the goods, even if I have not received any cash for it, but the moment I sell the goods, at that time my revenue is recognized. I am going to record in my books that the revenue has been realized for me. Similarly, like I gave you the example of a rent, I have rented my godown to somebody. Now, if I have rented my godown to somebody and that person is supposed to pay me in the month of March my rent, but due to certain reason that person is unable to pay and he pays me in the month of April. But my financial year ends on 31st March. So even though that person, like 31st March 2025. My financial year ends on 31st March 2025 and that person pays me on 2nd April 2025. Now, even though he pays me on 2nd April 2025, but that rent is for which financial year, which ends on 31st March 2025, and I'm supposed to uh, recognize it. I'm supposed to put it in my books for the financial year 31st March 2025. Okay. Similarly, if he gives me an advance rent on 22nd of March, if he is giving me an advance rent for on 22nd March for the April month 2025, I'm not going to record this. I'm not going to consider is this as my income for that particular year. This income will be realized, will be recognized for 31st March 2026 for this financial year, which ends on 31st March 2026. The advanced rent that I have received will be recognized for 31st March 2026 and not for 31st March 2025. So when the revenue is recognized, first thing, if I have made a sale, if I have sold the goods, the moment I sold the goods, my revenue is recognized. I have realized my income. And secondly, whenever another form of income is generated, if it belongs to that particular year, even though I have received it, I have not received it, but if it belongs to that particular year, in that particular year I'm supposed to recognize my revenue. But if I have received an advance, I am not supposed to consider it as my revenue for that year. It will be for the next financial year. Okay. But there are certain exceptions for that, like in the construction contract. Okay, the construction, it takes time to construct a building. When there are builders who are developing let's say, society, they are going to take time to build the society. So when they will recognize their revenue, it is based on installments. Okay, now the groundwork is done, they are supposed to recognize the groundwork revenue for that particular year. They have kept first slab, second slab, third slab, this particular work is done, and that particular moment. These are certain exceptions. Otherwise, the revenue is recognized the moment sale is made or the other income for that particular year. Then comes matching concept. What is the matching concept? The revenue is recognized for that particular year. The expense also is supposed to be considered for that particular year. Now the expenses, I'm giving salary to somebody. Okay, I'm saying but okay, the entity is giving salary to somebody. Now that salary, let's say he forgot to pay the salary to that particular person for 2 months. Now that is an expense for this. Maybe he pays it in the month of April, but that is his expense. He has to pay that salary. So that expense will be recorded in the books for this particular year. It has to be matched. The expenses incurred and the revenue earned for that year, that has to be matched. That is what the matching concept says. Full disclosure. Full disclosure, we have to disclose each and everything. Any changes made in the books of accounts, we have to disclose, because the users of financial statement, the owner is different, and the one who is running the business organization in companies, there are managers, CEOs, CFOs, and the owner is somebody else. So the owner is not going to come and see what changes you have made. Okay, he wants to see his books of accounts. He doesn't have how he will get to know, when he will see the books. Okay, and in that books, if certain changes have been made, certain policies they have adopted, so they have to mention those policies as a footnote in their books of accounts. Or else the shareholders investing money in the business, they are not dealing with the businesses, like what is going inside the business. Okay, they want to, if they want to know anything, okay, about the business, how they will get to know? When they will see the books, the financial statements. And that is why it is said the financial statement is supposed to disclose each and everything, any policies, the charge, even charging depreciation. There are two ways: written down value method and straight line method. These are two ways. We are going to discuss about it, what are these, but that is a way of charging depreciation. Now for few years, if the company is charging straight line method way of depreciation, suddenly for some reason they changes to written down value method, they have to mention it why they have changed it, because, and that change is going to affect the books. It is going to impact the business's profits. It's going to impact the business loss, the financial statement. It is going to affect it. So if there is any change in the policies, that policies they have to show it as a footnote, like because of this change in policy, there is the profit or loss have mm, uh, they profit or loss have there are certain changes in the profit or loss account. Okay, so when we are preparing the books of accounts, we have to disclose all everything properly. Third, another concept is consistency. Consistency says, okay, today I am going to uh, for example, in the company, in the organization, the like I just now told you, there is a method charging of depreciation, straight line method, written down value method. Company can't say, okay, today I feel like I'll charge straight line method. After some time, okay, I'll charge it at a written down value method. It doesn't happen like that. You have to be consistent unless there is a requirement, unless there is such a need wherein you have to change the method of depreciation, you can. But otherwise you can't every time, every period you keep on changing your method of depreciation. Or like I said, the when we historical cost, in that also we discussed that they have to prepare it based on the cost at what they have purchased the asset. They can't sometimes keep it at market value, at sometimes at cost value. That is not feasible. The market value, if the market value increases, it show a gloom uh, beautiful picture of the books of accounts. The market value have rise, okay, let's keep it the let's charge the assets based on market value. Obviously it will show a beautiful picture of the books of accounts. That is not we are supposed to do. We have to consistently follow the same accounting policies, same accounting standards. It's not, I'm not saying they are static in nature. At times they have to change, but we have to maintain that uniformity. If that uniformity and consistency is not being maintained, the books of accounts are not going to show the true and fair view of the business. Okay, so we have to follow certain accounting policies. Conservatism. Conservatism, it's like provide for all losses and don't consider any benefit. Don't consider, okay, like for example, I have sold goods to somebody, that that becomes my data. Now I know, like in your group also you get to know, okay, if I am giving this money to this person, I know this person will not return me, or he will take time to return me. Similarly in businesses also happens like that, obviously. So there are certain debtors, I have sold the goods to them, but I know that person is not going to give me the money on time, or may not give me at all. Okay, so I have to provide for all the losses. I am conservative. I want to show my books of accounts in such a way that it does not over do over profitalization of the business. It does not overdo anything. So when there are debtors, I bad debts. I call it as bad debts. As no, like this person is not going to give me money. Let me charge the expense from this financial year only. I will call them as bad debts. Okay, that I'll close their accounts. Okay, so I try to be conservative. I won't say like if I know there is a creditor to whom if I pay the money, I know I'm going to pay that person, my creditor, the money, and that person is going to give me a certain discount. I know it, but I'm not going to charge it I'm not going to show it in my books of accounts. I am being conservative. I am going to show the expenses which I may incur. I provide for all the losses and expenses. Okay, that is being conservatism. The second last concept is materiality. Materiality, let's say this pen. Okay, I have purchased 10 quantities of this pen, but if this is not material for me, but I have got this board, that is material for me. Okay, similarly, in a business, they are buying certain stationery items. Now they are charging. I know this pen is I'm going to use this pen for next year also. Maybe, I don't know. But this pen will be used for next year, or say for the business, for the entity, they are buying stationery items, and that stationery items will be used for next year also. They are buying pencils, they are buying pens for writing something, for doing something. Now they are not going to show it as a stock for the next financial year. They are having, let's say, 20 pens right now. They purchase 20 pens. That expenses of 20 pens, they are going to charge it in this year only. Even though 5 pens are left unused, they are not going to show it in the books like as a stock, this 5 pens, because that is not material. The business which is running into lakhs, thousands, crores, such information is not maybe for a small business firm it matters, but for a company it's not going to matter. But if I'm going to purchase a laptop for my business, that is a material information. I have to show it in my books. So anything that depends on the business firms. Okay, anything which is material, you have to show it. If it is not material, you are not supposed to, the penny expenses that you are doing, you are not supposed to show it in the next financial year. Okay, this expenses will be carried forward to next year. These expenses are charged in that particular year. Objectivity. Now what is objectivity? Whenever we are preparing the books of accounts, I have told you earlier also, it should be free from bias. It should not be favoring somebody. It should not be on somebody's interest. Now how we will get to know? It should be based, if there is a certain facts, certain evidence, it should be based on certain facts and evidence. If it is not based on facts and evidence, if the accountant feel like, okay, let me show a good picture of the books of accounts, you can't do it. There are users, it's going to affect the decision of the users. The users are having a trust on you because they believe that whatever transactions you have recorded, they are based on certain facts and evidence. If I am buying certain goods on cash, I have invoice for that. The voucher is the evidence. It shows, okay, I have purchased it. Or if I am selling the goods, I have that documentary evidence, and based on that only the users, they build the trust on the books of accounts, because there is an object involved which shows there is a facts and evidence. Even the court, the judge, why do they, why saboot chahiye hame. Okay, that is why they trust the judge, because he knows he will collect all the facts and evidence, and based on that only he is going to give the judgment. Similarly, when we are preparing our books of accounts are dependent on certain facts and evidence. That is the objectivity, and that is also one of the reason to keep the assets, to keep the things on historical cost, because there is a fact, the market value is going to change. That is not a factual evidence for us, but the receipt that we have received for the payment of the asset, the cost, that is why we write it on a historical cost. So these are the accounting concepts, these are the assumptions, these are the ideas, these are the things on which, if the users know that they have been the books have been performed uniformly, the policies are consistent, there are accounting standards they have followed, which has been framed by what the professional body is, ICAI. They have framed certain accounting standard based on which our books of accounts is prepared, and on these concepts, on these assumptions, we have prepared the books of accounts, and we can trust on it. Okay.